Analyzing a very interesting mid-cap player from the textile and retail space, Saraswati Saree Depot Limited, or SSDL. This company is showing strong growth momentum in FY26 and is catching the eye of value investors. Let's break it down step by step. SSDL has been a well-known name in the sari wholesale business, but in recent years, it has also expanded into men's ethnic wear and retail outlets. So, while its base remains strong in saris, the company is slowly diversifying its revenue streams. But like most textile companies, its business is seasonal, with high demand during festive and wedding seasons. Now let's look at the numbers from Q1 FY26. Revenue grew 11.1% year-on-year, driven by higher volumes and better customer wallet share. EBITDA was up 14.4%, showing better operational efficiency. EBITDA margin expanded to 6.2% compared to 6% last year. Net profit was up 4.1%, though PAT margin slipped slightly to 4.39% because of higher depreciation and lease-related costs. One big positive: the company is almost debt-free, and over the last 3 years, it has delivered an impressive average return on equity of 42.5%. That's outstanding for a textile player. From a valuation perspective, the PE ratio is 11.5 times, which is much lower than peers, making it look attractive. The intrinsic value estimate is around 101 per share, while the stock trades near 90 to 91. That's about an 11% undervaluation. EV/EBITDA at 8.4 times and EV revenue at 0.5 times also suggests the stock is fairly priced and not overvalued. But investors should also consider the risks. Margins are thin, and the PAT margin actually declined slightly in Q1. The company is expanding into retail and new categories, which increases operating costs. Since the business is seasonal, sales heavily depend on festive and wedding demand. On the positive side, the company declared an interim dividend in FY26, which shows management confidence in growth. So what's the bottom line? SSDL looks like a fundamentally sound company with strong growth, high return on equity, almost no debt, and valuations that still leave a little room for upside. For value investors, this can be an interesting stock to hold. But remember, this isn't a deep value bargain. Margins are thin, and expansion costs could pressure profits in the near term. If you're looking for steady growth and modest undervaluation, SSDL deserves a spot on your watch list. But if you want high margins and big discounts to intrinsic value, you might want to be a bit cautious. That wraps up our analysis of Saraswati Saree Depot Limited. Do you think SSDL is a hidden gem in the textile space, or is it just fairly valued right now? Let me know your thoughts in the comments. And don't forget to like this video and subscribe for more deep dive stock analysis.